Have you ever felt like you're just chasing these massive trades, getting greedy and then ending up totally frustrated? Well, what if there was a different way? A disciplined approach to aim for small, consistent profits day in and day out. That's exactly what we're going to break down today. Welcome to AI Explains ICT. In this video, we're diving deep into the core content from Month 9, Episode 3. Our whole focus is going to be on two specific, repeatable methods for hitting a consistent daily profit goal. So, let's get right into it. All right, the entire strategy, the whole mindset, it all revolves around this one simple number, 20 pips. Look, this isn't about getting rich overnight. It's about setting a realistic, manageable goal that you can hit over and over. This is the daily objective we're hunting for. Okay, now before we go any further, we have to get something straight. Let's be real. You're not going to make 20 pips every single day. That's a direct quote from ICT right there. This is not some magic formula. The whole point is to have a structured, disciplined plan for the days when the conditions are perfect. So here's our game plan. We've talked about the goal. Next up, we're going to break down two different methods for grabbing those 20 pips. One for the Asian session and one for New York. Then we'll see how one of these patterns is kind of universal, and we'll wrap it all up with the key principles you need to stay disciplined. Let's kick things off with Method 1. This one is specifically designed for the Asian trading session. So, if you're someone who's looking at the charts between, say, 8 p.m. and midnight New York time, this pattern is for you. So, what's the logic here? Well, it's actually pretty simple. The Asian session tends to be a lower volume market that just consolidates, right? It goes sideways. We're not looking for some huge breakout. Instead, we're just waiting for the price to make a quick little run to trigger the stop-loss orders from the end of the New York session. As soon as that liquidity gets grabbed, we trade against that move, betting it's going to snap right back into the range. So, for a sell, here's exactly what you do, step by step. First, find a clear short-term high that was made late in the New York session. Second, you just wait. As the Asian session opens, you watch for the price to trade just above that high. Third, once it pokes through that level, you look to go short. And fourth, and this is key, you set a fixed 20 pip target and a fixed 20 pip stop. And here it is playing out right on the chart. You see where those late NY stops are sitting? Right as the Asian session gets going, the price pushes up, grabs that liquidity, and then bam, it immediately reverses. That blue box shows our 20 pip target and it gets hit perfectly. And just so you know, this wasn't a one-time thing. Here it is again on the dollar/yen. The exact same logic. A high is made later in New York, price trades above it during Asia, and you fade that move for a quick 20 pip scalp. See? It's a repeatable pattern. And of course, this works for buys too. It's just the mirror image. You can see it here on the Kiwi/dollar. You find a short-term low from late New York, price dips just below it during Asia to snatch up the liquidity, and that's your cue to buy the rally for, you guessed it, 20 pips.
Now, this is probably the most crucial part of this whole method, discipline. Your target is 20 pips. Your stop loss is 20 pips. It's a 1-to-1 risk reward, and it's fixed. You are not trying to turn this into a 100-pip home run. You get your scalp, and you're done. This is how you stop greed from messing up your strategy.
Okay, let's shift gears and talk about our second method, which is all about the New York session. Now, according to ICT, this next pattern is way more universal. It works well on pretty much all pairs.
Remember how the Asian session scalp was a reversal strategy? Well, this one is the opposite. It's a continuation pattern. The main idea is that the London session has probably already set the high or the low for the day. So what we do is we wait for the New York Open to cause a little pullback, another stop hunt, before the price continues in the direction it was already going.
Okay, so for a buy setup, the conditions are very specific. First, you need to see that the London session has already put in what you think is the low of the day. Second, the price has rallied away from that low. Third, during the New York Open, the price pulls back and dips just below a recent 5-minute low. That's your entry signal. You go long, expecting the price to keep expanding higher.
Let's look at this Aussie/dollar chart and see how this works. You can see the price made its low during the London session. Then it rallied. Right at the New York Open, it pulls back, takes out the stops below that little short-term low, and then just expands beautifully to the upside. An easy 20-pip objective right there.
And here's the flip side for a sell on the euro/dollar. The London session clearly set the high of the day. Then, during the New York Open, price retraces up with a small rally, pokes above a recent 5-minute high to take out those stops, and that's your signal to get short, expecting the downtrend to continue.
You know, What's fantastic about this pattern is just how often it can show up. Check out this $/CAD chart. You can see two separate opportunities in the exact same New York session. Price dips below a short-term low and rallies for 20 pips, and then a little bit later, it does the exact same thing all over again. That kind of frequency makes this a really powerful tool to have.
All right, now we get to the really exciting part. This second method, the New York expansion model, it's not just for Forex. This is a universal market principle.
There's a reason ICT calls this a wonder pattern. I mean, the logic behind it, one session creates a high or low, the next session has a stop hunt, and then price continues. That's just fundamental market behavior. It happens over and over and over again.
And when he says universal, he really means it. We're not just talking Forex anymore. We're talking S&P futures, the Dow, the NASDAQ, even individual stocks you're day trading, commodities, bonds, it doesn't matter. The underlying principle of liquidity and order flow is the same across the board.
So, we've covered two powerful methods, but none of this works without the right mindset. A tool is only as good as the person using it. So let's wrap this all up with the core principles of discipline you absolutely need to trade these setups well. Think of this as your simple, daily trading checklist. First, you always have to do your homework and figure out the market profile. Is the market likely to expand or just consolidate? Second, you have to be rigid about your fixed 20-pip target and 20-pip stop. No exceptions. And finally, you have to practice. Don't just jump in with real money. Watch these patterns play out day after day until you really get a feel for them. I want to leave you with this final thought from ICT because I think it really brings everything together. The goal here isn't to get rich on one trade. It's about using all these broader concepts, market structure, liquidity, to scalp for consistent, small gains. This is a marathon, not a sprint.
If you found this breakdown helpful, do me a favor and like this video. And make sure you subscribe to the channel for more deep dives into ICT's concepts. And hey, if you have any questions at all, just leave them in the comments below, and a human will get back to you. Until next time, safe trading.